Hello, people. How's it going, man? Josh, what I do is I show how to use the technical tools properly. Each technical tool, I don't show my trades because it won't really help you guys. It's just about showing you guys how to use the technical indicators correctly. I'm good, thanks. Today, I've had a couple of people. I'm glad you understand, Josh. Today, I've had a couple of people ask to look at the Ichimoku cloud. Have any of you guys heard of it? Does anyone use it? It isn't actually useless. It just appears to be useless. But I'll show you a way that makes it a good tool. But first off, for the first couple of minutes, I'll answer a couple of questions just in case a few people want to get in and they're taking a bit long. So has anyone got any questions that I can do for the first couple of minutes? Strategies. Well, what I do is I'll show you how to use each technical tool, and then you can bring the technical tools together and help yourself develop a strategy. I haven't been back on WhatsApp yet, but I will be after the webinar, and you can answer the question. You can ask the questions in the webinar as well. Yeah, Jay, I'd say the best candle signals are bullish reversal candlestick patterns and bearish reversal. Hello? I'm not too sure what happened there, but I'm back in action. Can you hear me now? Okay, that's good. Yeah, so we're going to be looking at the Ichimoku cloud for the first section of things. And I know a lot of you guys don't really believe in the Ichimoku cloud. And when I first saw the cloud, I didn't really believe in it myself. But based on my experience, I found a way that everybody can benefit from it. So I'm going to go on the chart now. You find it by insert indicators, custom, Ichimoku, which is there. I'll just leave it on reset. Okay. And this is how it appears on the chart. This is the reason why a lot of people don't actually believe in the chart, because you've got this green line here, the purple line. It can tell you a lot of things that it doesn't need to tell you. But the most important part about the Ichimoku is the actual cloud itself. So the first thing you need to do is just to clean it up a bit. So right click, properties, colors. One second. The property. So we bring in the blue. So remove the green. Remove the blue. Remove. So what you do, let me just. That's better. So basically, this is the Ichimoku cloud. And as you can see, I deleted all the other settings on there so that we're just basically left with the cloud. And the best way to use this is you sort of use it like support and resistance. Press the chart shift now. What you'll actually see is the Ichimoku cloud projects a cloud ahead of price, and it's basically to show where price is likely to find a level of support or a level of resistance. So if I right click now, right click on the Ichimoku cloud and the properties, this is how you should have the color set up. I'll make the lines a bit stronger so you can see a bit more, a bit clearer, sorry. Yeah, so you can see it a lot clearer now. The color's not. Yeah, you can see a lot clearer now, and basically the Ichimoku cloud, how I've set it up now, is to show you support and resistance levels. Now, if you go back in time, you'll see that basically if price is moving down as it was here and price started to retrace upwards, this cloud is to show that it's to show you where price is likely to find the level of resistance. So for example, if you was to have a moving average here at this price as well, then you could take another sell position as it's showing a level of resistance. But also you can notice you've got a bearish candlestick formation, which is here. You've got the evening star candlestick formation. So basically this is a level of resistance. The cloud is acting as a level of resistance, and you have a bearish reversal candlestick pattern happening within the cloud itself. As you can see here, the cloud is acting as a level of resistance here as price was pushing up, but price got pushed back down by the sellers. And then eventually when price broke above the Ichimoku cloud, you can see that price then found a level of support on the cloud here, as you got a strong bullish engulfing candlestick pattern. So on the trade here, if you entered on the bearish reversal candlestick pattern here that happened within the cloud, you could have potentially made over 200 pips. And if you entered the trade here, where what was once resistance acted as support, so the cloud is now acting as support, you could have got into the trade on the close of the bullish engulfing candlestick pattern and potentially made over 120 pips. So those are two examples so far. And as you can see, price it's not the best indicator. However, when you sort of clean it up a lot, you can see how it is a good tool to be used in order to help you identify where support and resistance levels are. And remember where I showed you on previous days how to identify support and resistance levels, and also how to use the moving average as a support and resistance level. If you had this tool added as well, it would help you to further determine your level of support resistance levels. I know some of you guys are finding it a bit difficult to work out where to lock in profit or where to cash out. So for example, you could use the Ichimoku cloud to help you do that by simply, if you was long on a position around this level here, if you was long on a trade at this price here and price continued to go up, it is a bit of a bit slow for locking in profit, but it's a good example of how you could lock in profit. Just keep your stop loss according to the inner line of the Ichimoku cloud, where you could have gotten to there, but then again you can use the parabolic SAR. But again, it's not the best tool to use. The Ichimoku cloud isn't. However, it's a tool that can be used to help you make your trading decisions. You can see how if you've already marked out your level of support and resistance and your levels are also within the Ichimoku cloud, you can see how it gives you more confidence for taking the trade, basically. I'll find an example of that because I know a lot of you guys still aren't convinced, but as somebody requested for me to show you guys how to use the Ichimoku cloud, I did it. Let's see this. And this is just a good example. I've drawn the Fibonacci levels. I'll show you how to do Fibonacci if some of you don't know, but I drew the Fibonacci from the low to the high. And what we're imagining is if we don't know what's happening next. So for example, price got as high as this level, but price has started to retrace. Now you'd like to know where price is likely to find the level of support. So what you do, or what you could do, is draw your Fibonacci line in, and based on when you draw your Fibonacci, you know that price is likely to find the level of support between your 38.2 level and your 66.0 level. So I'll just highlight that now. Make it green. And if you notice within this level, you've got this is an example of how you can use the Ichimoku cloud to help you when using Fibonacci. So for instance, you've drawn your Fibonacci levels, you've drawn your Fibonacci, you've marked out your key levels within your Fibonacci, which is between the 38.2 and the 66.0 level. And you could say that once price enters that level, you'll wait for a bullish candlestick reversal pattern in order for you to enter the market. And as you can see, if you look at these two candles here, you have a strong bullish engulfing candlestick pattern, as you've got this strong green candle engulfing the previous bearish candlestick body. But however, as you can see, if you entered this trade, price did go lower than the low of this candlestick pattern here, so you would have lost money. But basically, if it was part of your strategy that you would only take the trade as long as price was within the 38.2 level and price was also touching your cloud, as you can see, if you look at these two candlesticks here, you do have a bullish engulfing candlestick pattern, which is within your 38.2 level, within your 38.2 level and the 66.0 level, and is also touching your Ichimoku cloud. So those are a few confluences that can help you. I'm just going to check the chat now. What's the difference in this? Russ said, which would you say is more effective, the Ichimoku cloud or the support and resistance levels based on candlestick patterns we learned about yesterday? Me personally, I'd say the candlestick patterns. That's what I use myself. However, I've just shown you an example where if you just solely rely on candlestick patterns, then it may not work as well. But however, if you can put candlestick patterns to work with the Ichimoku cloud, then it is stronger. So that's why I'm showing you guys a way that you can actually intertwine everything together in order to help you make profitable trades and reduce the amount of losing trades. So for instance, at this bullish engulfing candlestick pattern here, if you just solely relied on candlestick patterns, you would have lost money. However, if you look at the bullish candlestick pattern, which also happens within the 38.2 and is also touching your cloud, then you wouldn't have taken this trade here. You would have only have taken this one and would have made money where you potentially could have made over 200 pips. Patricia asked, why do I have the 66.0 level? And based on my experience, if you test yourself as well, you'll see that when you do backtest Fibonacci, it's set as, the Fibonacci by default is set at 61.8, but when I did further reading and looked into, did a lot of backtesting for Fibonacci, I noticed that price does actually respect the 66.0 level. So that's just a little added bit of info that I got based on my experience. That's correct, Christian. Christian said that if you're using this, you have to know where to put your fib levels, because he has seen a lot of people putting fib levels all over the chart, and that's true. So we should go over, well, I should go over how to correctly draw your Fibonacci levels, which I will do. Okay, I will show you how to draw the fib level. Is everyone happy with how to understand the Ichimoku cloud now? It's basically very simple. You just use the cloud as basically support and resistance, and it's already set out for you. So as long as you set it up how I've showed you to set it up, as long as you set it up how I showed you to set it up, you won't have to do anything much. Basically, you just leave it as clouds that are on the chart, and if price is within them, then it can be used as support or resistance. So does anyone have any questions regarding the Ichimoku cloud, or would you like me to move on? What do you mean no? Do you want me to move on or explain a bit more or show a few more examples of the cloud? Okay, no one else got any questions about the cloud? Yeah, not everyone likes the cloud. Somebody asked me to show it, but you know, if you guys ask me to show something, I'll show it in regards to technical indicators, and that's what I did here. But now that no one else wants to see the Ichimoku cloud, we'll move on. So blank chart. Marvin, you need to show me where it is. So now we'll show the Fibonacci. Does everyone know what Fibonacci is? Yeah, people like the cloud because it looks a bit fancy, but when you clean it up a bit and you can just see it for what it is, which is support or resistance, you can actually find a use for it. You guys aren't too keen on it at the minute, but if you do get a chance and apply it to your chart, you can see how the support and resistance levels are respected within the cloud. But now we'll go to Fibonacci. Now, in regards to Fibonacci, you need to people need to understand that charts move in waves, so it's up and down. What you need to do in regards to placing Fibonacci, you need to always draw your for finding support, as in levels of support, you need to draw your Fibonacci from the low to the high. And when you're drawing Fibonacci to look for resistance, you draw the Fibonacci from the high to the low. And always go across. But I'll show that for example now. So, good example now. Fibonacci is up here. Fibonacci retracement. And what we'll do is we'll click on the button and drag it all the way to the top. Can you guys see this line clearly, or should I make it thicker? Okay, so basically, you don't ever want to be in a position where you're drawing the Fibonacci in the middle of nowhere. So never do this. Never draw Fibonacci in the middle of nowhere. Always draw the Fibonacci from the low to the high. It doesn't necessarily need to be as high as this now, but this is an example that I'm showing. So again, you draw it from, when you're looking for support, always draw from low to high. And this dotted line here, if you can see this dotted line, this needs to always slant forwards. So what I mean by that is you never slant backwards. So never ever slant backwards. So when looking for Fibonacci support, click from the bottom and drag it to the highest point at the top. Is everyone clear on that so far? Patricia, yes, you do go from wick to wick. It needs to, when you draw in Fibonacci, you need to go from wick to wick, as you need to take into consideration the full price within that area. So just by doing it to the close isn't good enough. You need to do the actual whole candlestick. So that's why you go to the low here, and that's why you go to the high here. Everyone understand that so far? Okay. When you draw your Fibonacci levels, the key levels are between the 38.2 level and the 66.0 level. When you guys actually put the Fibonacci onto the chart, if you right click, go to Fibo properties and scroll down, you can see that what you do is add, well, I've already done it here, but you click add and you press 0.66 and 0.66 there, or 66 there. So 0.66 here and 66. But because I've already done that, you don't need, I'm not going to show that example, but you understand that. And then once you've done that, you'll have this level here, which is the added level. So as standard, the Fibonacci will only have the 61.8 level. Based on my experience, I also add a 66.0 level, which is here. So make sure you do that, guys. And once you've drawn your Fibonacci, again, remember the strongest levels are between the 38.2 and the 66.0. So what I'd recommend is highlighting that area. We'll do this in green because Christian, they need to do some more research. And I read a book somewhere, I can't remember which book it was. I did a lot of research at the time. I actually studied Fibonacci to a deeper level, and I did see that 66.0 worked well. Then I actually backtested it for many years of data, and I found that the 66 level was respected. Hopefully, when we go through examples here, you will see that the 66 level does work well, sorry. But yeah, once we've drawn out the levels, once we've drawn the Fibonacci, we'll mark out the key level, which is between the 38.2 and the 66.0 level. And how you'd actually do this now, say for example, price was going up and it started retracing, but you'd like to know where price is likely to find a level of support. So you draw your Fibonacci and mark out your key level, which is between 38.2 and 66.0. And as you guys know, price moves in a wave, so it goes up, down, up, down, up, down. So when price is retracing, you know, based on your level, price is likely to find a level of support within this area. And as you can see, you have a bullish engulfing candlestick pattern which occurred within the 38.2 level and the 66.0 level, as you've got this bullish engulfing candlestick pattern. So if you entered on the close of that candlestick pattern, which is here, you could have potentially still been in the trade and you could be up 57 pips. Does everyone understand this first example that I've shown of support for Fibonacci? Okay, a few more yeses. Any questions about Fibonacci so far? Ross, you can apply Fibonacci to any size trend. However, I wouldn't recommend going too small, but I'll show examples of that. Like you can use the Fibonacci on any time frame. However, the Fibonacci is stronger on it's not as strong on lower time frames. So like the 5-minute chart or the 15-minute chart. But you can go to lower time frames to find an entry, as we did do yesterday. But again, the key thing about Fibonacci is to help you identify a key level, and your when drawn properly, your key level will be between the 38.2 level and the 66.0 level. But I'm going to find another example now. And again, all the stuff that I show you can be used on any time frame and any currency pair. Let's find a good example here. Let's see this one. No, it's not a perfect example. I'm trying to find a perfect example for you guys. Here's a good example. So just find this example here. You draw the Fibonacci from the low point to the high point. The high point is not this point here. It's that point, as you can see, it's sticking up. So once you draw your, again, when we do back tests, what you're imagining is that price is up, price has gone up, price has started retracing. Once you've seen that price is starting to retrace, you'll then draw your Fibonacci, as you'd like to use your Fibonacci to help you identify where price is likely to find the level of support. In this instance, when using Fibonacci, it's between the 38.2 level and the 66.0 level. So I'll just highlight this area again. And as you can see, within this level, within this area, sorry, you do have a bullish engulfing candlestick pattern which happened here, but price did go a bit lower. So depending on where you had your stop loss, you could have lost money. So if you had your stop loss at the 66.0 level, then you'd still be in the trade. However, if you got stopped out because you had the stop loss there, then you lost money. But you did have another opportunity to enter the trade as you have a bullish engulfing candlestick pattern, these two candlesticks here. And if you entered on the close of this pattern, you could have potentially made just over 90 pips. So that's another example of how you can use Fibonacci to find a level of support. Does everyone understand that so far? Jay, I'll explain the RSI to you in WhatsApp. So no one's got any questions about this so far? I wouldn't recommend Fibonacci expansion. However, it can be used as a level for take profits. We'll move on to that I'm going to find two examples of Fibonacci for sell. And then as long as everybody understands it, we'll move on to the expansion quickly. Because I've seen a lot of people draw that wrong, but I'll just leave them to do their thing. So now we'll look for Fibonacci for a sell position. But when you're in an uptrend, you wouldn't really use basically, if you use Fibonacci, you should always know what trend you're in beforehand. So you can either use you can either use the simple explanation of what uptrend is, so higher highs and higher lows. If you are in higher highs and higher lows, you use Fibonacci to identify support. If you're in a downtrend, i.e. prices showing lower highs and lower lows, then you use Fibonacci to help you identify resistance levels. But because you can clearly see that at this moment in time, the Euro USD is in an uptrend, that's why I haven't yet found any examples of how to correctly use Fibonacci for resistance levels. No. Well, that's a good example. No, not good. I'm just going to change the currency pair. Again, you can use all these technicals on any currency pair. It doesn't have a favorite. But we need to find one that's in a downtrend so we can find for resistance. I'll also show you guys using the strategy tester, how you use it in a live market as well. This is why a lot of people don't backtest, because it is quite long and tedious, but as long as you can find the example, you will be fine. We'll just go back. Finally. So for example, if we're in a price that's made a sell-off here, and then prices started retracing. So for example, if you can see that price had a strong sell-off, but price started to retrace and go upwards, you'd like to know where price is likely to find the level of resistance. So what you do is you draw your Fibonacci, and when you draw your Fibonacci for resistance, you draw it from high to low, which is from this high there to that low there. You go across, and then you mark out your level of resistance, which is between your 38.2 level and 66.0 level. And because we're looking for resistance now, I'll make this red. Oh, that's too red, sorry. And as you can see, so for example, price went down, it started to retrace with strong bullish candles. you're wondering where price is likely to find a level of resistance. So what you do is you mark out your Fibonacci, and then you mark out your level of resistance between the 38.2 and the 66.0 level. Once you've done that, you'll then look for bearish candlestick patterns, or you could look for some other kind of sell signal. But when you're using candlesticks, there's nothing better to use than a bearish reversal candlestick pattern. And you have one here, which is a bearish engulfing pattern. And if you entered on the close of this pattern now, that happened within this 38.2 and the 66.0 level, you could have potentially made, well, over 100 pips there if you wait to the bottom, over 200 pips. Rob, I don't trade currency pairs on the index, no. The top reversal candlestick patterns I'd recommend, Jay, are bullish engulfing candlestick patterns, bearish engulfing patterns, and hammers, and also morning stars and even stars. Zidane, I don't trade exotic pairs, no. I trade 6 currency pairs, but that's based upon the risk management I'd like to take. It's based upon the volatility within that specific market, and also it's based upon the back-tested data that I've got to show performance and how that specific currency pair acts towards my trading strategy, because not all strategies work well on all currency pairs. So for a currency pair with low volatility, certain specific strategies won't work as well. Russ, you can use the 66.0 level as your stop loss. That will be fine. However, it can affect your risk management, because, for example, if your risk management is another subject, but again, you can use your 66.0 level as a stop loss. Yes. I'm not going to name any of my strategies. However, everything that I'm showing you guys now is part of the strategy that I use to enter the trades and how I use it to manage my money. So I can help you guys use technical tools correctly in order for you to develop your own trading strategies. Marvin, I go back as far as possible when backtesting. Oh, what did you ask about the 6 pairs, Jay? Sorry. In regard to the 100 pip stop, Jeremy, it doesn't really matter how much your stop loss is, as long as you are managing risk properly and you're going to cash out enough profits. 1 year back testing isn't enough. You want to back test a lot more than that so you can get more data. Does everyone understand how to use the Fibonacci for sell position? Or do you have any questions? So no questions about Fibonacci? Anybody get any questions about Fibonacci? Literally any? It's quite simple. When you join Fibonacci for a sell, I'll go over it again. You draw it from high to low. And when you join Fibonacci for a buy, you draw it from low to high. Okay, now that everyone understands the cloud that we went over, the Fibonacci retracement, I'll also cover Fibonacci expansion. So how you use Fibonacci expansion is it's to help you identify where price is likely to find a level of resistance, or you can also use it as a point of take profit. For example, in the first example that we used, when I drew Fibonacci on the Euro USD 4-hour time frame, I'll just quickly draw it now so you can remember. From low to high, I marked out this area here. Oh no, not that. Let's make it green. So yeah, this was the first example I showed, and we can see that price found a level of support here. But if he was in this trade now, where we could have been up potentially just over 50 pips. A lot of people are wondering where they should cash out or where price is likely to find a level of resistance or where you should place your take profit. And that's when the Fibonacci expansion tool is a great tool for helping you to place your take profits. So what you do, if it's not up there already, you can go to insert Fibonacci expansion. And what you do, you draw it exactly the same way, but however, this time you do 3 clicks. So you click once, drag up. Let me just change the color so you can see it better. So I deleted the first Fibonacci level that we had because I don't want to confuse you guys, but I've still kept in the level. And remember, this level is between the 66.0 and the 38.2 level. And then when you get your Fibonacci expansion, remember, insert Fibonacci expansion, you go from the bottom, drag to the top, then you place it to the top. So it's exactly the same. All you do, it's exactly the same as the Fibonacci retracement, where you go from the bottom to the top. But once you've gone from the bottom to the top, you notice you have a third one here, and you place this one at the point at which price found a level of support within that area. Once you've done that, if you this thing here, price, sorry, if you click it and go down, you'll see where the first level is. So basically, this is a price target, and it's showing where price is likely to find a level of resistance. So we'll go up, and that's potentially 270 pips, you could say. So that's an example of how to use it in a live market if you was in that trade. But now I'm going to find an example of where it actually worked as a take profit. So 1 second. So for example, if you drew the Fibonacci from here to there like we did last time, so from the bottom to the top, between the 38.2 and the 66.0. I'm going a bit fast now because you guys said that you know it and I don't want to waste your time. So if I'm going too fast, you should tell me, but I'm going to keep going. So I'll mark out this level between the 38.2 and the 66.0 level. Now I'm going to delete the previous Fibonacci. Remember, you still got your level. You still got that candle that you would have entered on, the bullish engulfing candlestick pattern. I'll put the entry price there. That's the price you would have entered as it's the close of the pattern. But then once you're in the trade, again, pretend that you entered the trade and you're not sure where price is going to go. So see, everything's easy in hindsight, but when you're actually backtesting, you use your backtesting and your trading technical tools to help you in a real life situation rather than in hindsight. So essentially, all you'll have to do is follow your strategy. But going back now, so you get the Fibonacci expansion, go to Fibonacci expansion, you draw it exactly the same. So you draw it from low to the high point, and then you move this second one, or sorry, this third one to the price or the point at which price found a level of support, which is here. And then now, when you enter the trade, you know that your first price point or your take profit overall would be this level here. So then you could set a take profit, which is 162 pips. But again, the problem when you do have a take profit point is that you potentially miss out on the rest of the trade, where you're potentially missing out on another 50 pips. But you can't win it all. And this Fibonacci expansion is a good tool to be used when you want to use it as a take profit or find out where price is likely to find a level of resistance or a level of support if you're looking for if you're short on a position. So does everyone understand that? Or any questions? So are there any questions about the Fibonacci expansion? So today we've covered the cloud, which people weren't too clear on, and I can understand why, but it does have its use. And I did show when it is beneficial to use the cloud. Then I showed how to draw Fibonacci retracement, and you guys said that you understood it, and you can see how valuable it is when used correctly, as long as you always draw it correctly. And the way I've explained it, you should always draw it correctly, but I recommend practicing and backtesting. Um, and then somebody asked me to show Fibonacci expansion, which I've also showed. Um, so does everybody understand those three things that we've gone over today? Or are there any questions? I don't use expansion, no. Grizzle. Me personally, I never set a take profit, but someone asked me what you can use it Fibonacci expansion for, and it works best for take profit or price targets. You can move your stop loss, but then that comes to your exit strategy of where you'd actually move your stop loss. You know, once price touches your level, where would you move your stop loss to? But that's another story in regards to your exit strategy. So now that we've done these and everybody understands them and nobody's got any questions, then you can fire some questions at me. So everyone feel free to ask anything. Volatility can be measured by how much a currency pair moves within a week. That's what I base it on. So if I delete all my stuff from my chart now, because I trade the 4-hour time frame, which is here, in between each of these dotted lines, these dotted vertical lines represents 1 week. So all I do is get the crosshair and calculate how much the currency pair moved in a week. And as long as it's between as long as it's over 100, then it has enough volatility for me. Ideally, we're looking at about 200 though. Any other questions? No worries. How long does your average trade run for? Well, someone said, how long does my average trade run for? And because I'm entering a 4-hour time frame, your trade you should be at least in a trade for 4 hours, because what you have to imagine is each candlestick represents 4 hours. So if you enter on this candlestick now and you think, oh, I've been in the trade for 3 hours and I'm not in profit, I'll just exit. You can see that you would have exited within this candlestick here. But as you can see, to be able to get the majority of this trade, you actually had to hold forward over 10 hours, over 10 candlesticks, which means over 40 hours, which is over 2 days. So that's how long an average trade can last as long as it takes, basically. You can do a CEO asks, do you use it on a lower time frame? What lower time frame are you referring to? Ross, my average trade length, sorry, I'd say is around, I'd say between, if I'm anywhere between an hour if I'm losing or whatever, or if the market is moving rapid. And the longest trade I've had is, I think it was 18 trading days or 21 trading days. You can use all the technical tools that I've showed on any time frame, CEO. So it can be 5 minute, 15 minute, 4 hour, daily, weekly, monthly. It's totally up to you. But I would say, if you, whatever time frame you're going to use it on, make sure you back test it, and don't be one of them people that find an example and say, oh, it works, so I'll just use this now. No, back testing means you really have to back test and really have to get the data. Once you've got the data, you can go through the data and improve your strategy. So that means you can reduce the amount of losing trades you've got, increase the amount of winning trades you've got, and overall optimize your strategy so that you get the best performance. Uh, Ross said, what makes you say back testing worked? A certain amount of examples proving it correct, basically. No. What you need to, well, that in short, that is an explanation. But what you need to do when backtesting is you need to be hard on yourself. You need to find examples of where it doesn't work. So, for example, when I did draw the Fibonacci, and you saw that even though price hit the 38.2 level, you lost money. So you would have lost that trade, but you would have, if you took this trade here, you would have lost it, but it didn't go lower than that part. Then you would have made profit here. So you could have had potentially 2 losing trades before you had 1 winning trade. So the reason you do backtesting is so you can get that sort of data. Once you've got that data, you then go into your skill set. That's why I'm showing you guys how to use all of these technical tools, because if you come across too many losses when you actually done your backtesting, you can then incorporate another technical tool to help you eradicate that loss. So for example, if you would have entered on this bullish candle here and you would have made a loss, and on this bullish candle here, you would have made a loss, but you would have made a profit here. You need to work out a way how you could eradicate these 2 losses, and that could be done by the thing that everybody hated just now, which was the Ichimoku cloud. But as you can see, if you use the Ichimoku cloud, ignoring all the other lines, and you waited until price went in the cloud, then you wouldn't have entered on these losing trades here. You would have got this winning trade. However, another example is if you're getting stopped out too much on this trade here, sorry, if you're getting stopped out on that trade there and on that trade there, you could simply just say, when you enter a trade, you'll put all your stop losses at the 66.0 level. However, when you do that, instead of having like a tight stop loss of around 30 pips, you could have a stop loss all the way at like 85 pips, which is not as good for your risk management. So I hope that explains what I just mentioned. No worries, Ross. I don't trade. I don't trade when the market first opens on a Sunday. I wait 4 hours at least for me to enter the market, but there is exceptions for me to enter before that. But someone said, how much backtesting would you recommend before taking live trades? What I always recommend first is this is the step-by-step process that everybody should do. And if you do it this way, it's quite impossible for you to fail. But because it's so long, people don't do it. But what you should do is you should learn how to use all the technical tools first, so you have a skill set and an understanding of each tool. Once you've done that, you then use your knowledge to develop a strategy. Then once you've developed the strategy, make sure you backtest the data as far as possible, and make sure you're being strict on yourself when you are backtesting. So that means not lying to yourself. It means showing where you would have lost money on them previous trades and making sure that you take a note of it. Then when you've got the data, you can identify how many losing trades you've got, how many winning trades you've got, how much profit you locked in, how much price went your way before it went wrong, so you can know when to move to break even. And once you've identified the amount of losing trades you've got, then you need to go back into your skill set find one of the technical tools that can help you reduce the amount of losing trades that you actually have. And then once you've done that, you then apply that knowledge that you've got to your strategy. So you modify your strategy. This is called strategy optimization. And then once you've optimized your strategy, you then backtest it again to see if your results have improved. And as long as you have backtested properly and you have added a technical tool in there which makes a difference, your results should have improved. Then once you've finally done that, you should forward test. Forward test meaning you can use strategy tester. I'll quickly show you what strategy tester is now. Quick example. So this is strategy tester. You can use it on the tool. Look, you can see I can speed up the market, slow it down, slow down. I can pause it, can speed it up. So you use that to forward test. Once you've done that, you can also demo trade as well. So when you demo trading, it means you trade in live markets, but with not real money. But make sure that when you are trading the demo account, you trade it as if you are trading real money. Then once you've traded the demo account and you are profitable, you can then go onto a live account with a lower amount of funds, like $1,000, to make sure that you're using correct risk management and following your strategy. As long as your performance is similar or exactly the same as your demo account, which should be this exactly the same as your back testing if you've done it properly, you can then start depositing more money as you're then believing yourself more. That sounds like a long process, but that's just because I've explained it. But however, it's the process that you should be doing in order to make sure that you become a consistently profitable trader. So I hope that explains the question. Jay, there's no five best pairs to trade. Again, the way basically each strategy that you may have, as long as it's a good strategy, will perform differently on each currency pair, and it will also perform differently on each time frame. So basically, because there are so many strategies that you can have, there's no best currency pair to trade for any one person. It's just dependent on that strategy that you decide to choose. So I hope that makes sense as well. Daniel said, if you enter a trade on GBP USD, would you also enter trades on the correlating pairs? And the answer to that question is no. I've done it before, but what you need to do is when you actually have a strategy, unless it was in your strategy to enter correlating pairs, which I wouldn't recommend, that's the only time that you would actually enter the trade. However, you should only enter trades if all boxes are ticked according to your strategy. So don't just simply enter a trade because it's a correlating pair or because you heard so and so say that it's going to go down. You always want to follow your own strategy in order for you to enter the market. And Russ said, how often do you find backtesting correlates to future market patterns? Do you get to a point where your expectations and predictions become better and better? In the short answer, sorry, is as long as you've got your strategy that you've developed and you follow it to a T, you all you're essentially doing is staring at the market or analyzing the market, sorry, and waiting for all boxes to be ticked on your strategy. The hard part about trading is to understand how to use the tools correctly and how to develop everything into a strategy. But once you've actually got your strategy and you understand how to use it, it's easy. All you need to do is simply follow the step-by-step instructions. It's like making a cup of tea. You can develop a strategy that works on all pairs. However, when you do develop a strategy, I would recommend backtesting on that specific currency pair that you are going to trade, because it's good to see how that currency pair acts in order for you to enter the market. And again, when you start risking real money and large money, you want to make sure that you're not messing around with your real money. So the best way to do that is to actually test stuff. Yeah, because a strategy is basically like a recipe. Any other questions? I love tea. Any other questions then? Yeah, I'm fine, thanks, Christian. What about yourself? So no one has any questions about the Fibonacci expansion or the Fibonacci retracement or the cloud? When I backtest, Jeremy, I stay on the time frame that I will be using for my entries. So if I was trading the 1 hour time frame, then I would backtest the 1 hour time frame. If I was trading the daily time frame, I'll backtest the daily time frame. So basically, you need to backtest the time frame that you're likely to use. If you're going to be entering on a 4-hour time frame, it's quite pointless backtesting a 5-minute time frame. The way you test two time frames is just simply putting them side by side. Someone said, how do you backtest two time frames? And all you do, drag another. So I've got the chart side by side now. And someone said, how do you test two time frames? You can simply have the 4-hour time frame there and the daily time frame there. Or you can have the 5-minute time frame there and the 30-minute time frame there. As long as you've got the currency pair the same. So you can do that on any currency pair, whether it's GBP, USD. Just make sure that it's both GBP, USD. Top-down analysis is in higher time frame going down to a lower time frame. Also, I forgot to mention one of the key things that is a problem nowadays is people thinking that analysis is a strategy, and it's not a strategy. The reason it's not a strategy is because analysis is simply analysis. Like, you're just using your technical tools to put analysis on a chart. However, a strategy is a strict step-by-step set of rules that you have to follow in order for you to enter the market. When you're using analysis, it's everything is relative. It's all subjective. There's no consistency, and because there's no consistency, there's no way it can be a strategy. Because again, how I define a strategy, or how anyone should define a strategy, is a step-by-step set of rules written down in stone that you need to follow in order for you to enter a trade. And analysis is completely the opposite to that. How long did it take you to... Russ said, how long did it take you to develop your strategy? It's something that I developed over time, yes, based on, again, with all my skill sets, I developed my strategy, then I've done back tests and got the data and then optimized it so it gave a better performance. But then when I traded it in live markets, if I found a common anomaly, like, you know the word anyway. If I found a common problem, I just made sure that I used one of my technical tools and applied it to my strategy in order to eradicate that problem, so I can reduce the amount of losing trades I can and increase the amount of profitable trades. Also, one of the reasons why I don't recommend, why I always recommend letting people know how to use all of the tools and how a strategy actually works itself, is because markets are very dynamic, as in something that's working this year may not work next year. What you should always do at the end of the year, you should look through the trades that you've taken and see how you could improve, basically. And the only way you can do that is by having your strategy written down in stone so you can see what you actually done. So for example, if someone said to me, or if someone has a problem and they don't even have a strategy written down, then how can they expect me to help them when I can't see what's in their head? That's why I always recommend having your strategy written down so I can immediately find the problems within the strategy. Because a lot of people, the problem in strategies is that people have there's too many variants. That's one of the problems that I always find. You can backtest using a Mac, but I always recommend using Windows. So if you can get like a boot camp or something so you can run Windows on it, then that will work. But again, just get a PC. My strategy, I don't want to scare you guys off, but it has a lot of... Basically, the reason why I needed my strategy to be so detailed is because when you're trading a large amount of money, And if you make a mistake, or if you don't, if your rules aren't as clear as day, then you can essentially lose a lot of money. Well, I can lose a lot of money. So because of that, I want literally everything to be clear as possible. And that's what I recommend everybody else doing as well. I'd recommend start day trading. Well, I'd recommend firstly not trading any live money at all, until you at least had a strategy and clear risk management. Otherwise, you literally throw money away. And then once you do have a strategy and you are making money on your demo account, I'd say just trade with £1,000, because simply you're not, when you are trading with £1,000, you're not in it to make a million straight away. The reason you trade in £1,000 is so that you can trade the live market with real funds and see how your emotions actually kick in when you are trading real money. That's the whole purpose of it. So now we're going through the technical tools, but there's also a psychological part that we need to go through, and the risk management part. So again, when trading with real money, don't start with any more than £1,000, because if you can't make money on £1,000, then don't. Why would you think you can make money on 100,000? I don't use support and resistance. No, Jay. Well, someone said, "What's a good strike rate?" But as long as you have good risk management, it doesn't really matter about your strike rate, because I think you can be as low as 40% successful, as long as you're cashing out 2 to 1 profit, and you'll still be profitable. Obviously, it will be better if you was like 80% strike rate and you were cashing out higher than 2 to 1, then you get more profits. But as long as you 40% right and getting 2 to 1, you'll still be a profitable trader. So your strategy, that's basically shows that your strategy is important, but risk management is more important. And risk and strategy is important because without a good strategy, you can't have good risk management, and you can't have a clear head for psychology. You can't have a clear head and get your emotions out of the game. Jeremy will fix that soon. It depends if you want to start stealing, Marvin, but I don't recommend it. Exactly. Paul Tudor Jones was my idol, to be honest with you. And one of the key things that he said is that many people keep focusing on how much money they can win, but the most important thing is to focus on how much money you can lose. Once you focus on that, a lot of things change. As long as you've got like the skill set, obviously. Ross, I did struggle with my emotions, but that was because I didn't have a strategy, and I tried to over risk. And when I over risk too much, I had to walk around the park and all sorts. So I stay away from that. No problem. So any more questions, then, guys? There's no risk, no reward. But basically, what you have to think about is, if you're trading and you decide that you're going to be a trader that trades big, risking a lot of money. Let's be honest with you. If you've got 250,000 in your account and you lose 200,000, you're not going to wake up the next morning to trade, and then you're going to miss out on your opportunities. You want to be in a position where you've got your trading strategy and you'll be trading whenever your opportunity comes. The only reason why people don't take trades is because they're scared. But as long as you've got a strategy and the correct risk management, you'll never get scared. RSI divergence. What question do you have about the RSI divergence? Because on WhatsApp, I can't show you. I've had a headache today, so I'm gonna hit the go bed, I think. Exactly. It's about trading is a business at the end of the day. You have to treat it like a business. So a lot of people that have problems cashing out profits, you know, in a business, you'd never throw away your profits just because you can't get as much as possible, which is crazy. Like, for example, over here, if you entered down here and price went at this high, it got to 168, but you're going to say, oh, I'm not going to cash out until I get to 200. If you do that, you're potentially going to get nothing. So treat it as a business, lock in your profit, manage risk properly. No worries, Marvin. But the reason why I know so much that I do know is because everything that you guys are going through and everything that you speak of, I've actually gone through myself. So that's why I say you can literally ask me any question in regards to trading and I'll know the answer to it. I'm not lying to you guys when I actually say that. Jeremy, to catch big moves, you just follow your strategy. To make your strategy, you have to know how to use the technical tools and then you can do anything. I don't trade shares because I trade what works for me now, and I haven't had a problem with it, so I just stay with that. But Jay asked about the RSI, so I'll quickly show that. You guys saw it yesterday. I'm not going to go into it too much, but so here's divergence here, that low there, and again, when you backtest so much, you can easily find divergence because you've seen it so many times. So for bullish divergence, price needs to slope downwards, RSI slope upwards. For bearish divergence, price needs to slope upwards. As you can see, it goes up, and the RSI needs to slope downwards. So that's for Jay. Jay asked about the divergence. So any other questions then, guys? I don't go in. Me personally, I stay on the 4-hour time frame because I don't want to sit at my chart all day and trade. Like, they make it look cool on the telly because that you sit at the chart all day, but that's not fun. When I first got a sports car, I used to, before I had a fast car, I used to sit at the chart all day, and I did think it was fun. But when I had a fast car, I realized that driving around was fun, so I did that for a bit. But then I got too many points, and that's another story. So. No, there's no exceptions when they're both in slope in the same direction. No, you can go to lower time frames, but that's up to you if you want to do that. You just need to have that as part of your strategy if you are going to do that. I have 6 monitors, but when I'm out, I just have my laptop. So you don't need so many screens or so many monitors, but it does help when you're backtesting. So instead of having charts side by side, you can simply have them on each separate screen. My maximum drawdown that I have is minus 20%. Any more questions? Or we call it a day. Also, I don't cry. Men don't cry. Also, what I was going to say to you guys is if you remember on Friday, what I'll do is if you've got any problems, analyze the chart like this, put some labels on there. So put a text on there. You could say help. Make sure you label the chart properly, even add an arrow so I can see what you're looking at. And then what I'll do is on Friday, I'm going to go through everyone's problems and I'll help all you guys. So make sure that you analyze the chart properly or put whatever you got to put on the chart properly and label it. Because if I can't understand it, I'm not going to keep on asking. So make sure you label the chart properly. Then I'll tell you to email it me. I'll send this in the WhatsApp as well. I'll tell you guys to email me the problem And I won't say any names on there, but I'll pull up the chart and find the solution to your problem. I don't have the details. What? Automated robots are reliable. I do have one myself. I have one that manages trades for me. So I I manually enter the trade. However, the robot manages the position for me. And I also have one that does entering and trade management. And they are reliable as long as you test them. But I've got robots myself. But yeah, so make sure you guys do analyze your charts and make sure you label them so that when we do have the session on Friday, I'll be going through all the problems that you have and I'll be finding solutions. So as many problems as you want, I guarantee I'll find the solution because I've already done it. So, but yeah, hopefully you guys understand the cloud, even though some of you didn't like it. I did show you how you can actually benefit from it. So hopefully you can use that and test it out. I did show you how to correctly draw the Fibonacci. I recommend drawing it a few times, drawing it as many times as you can yourself to make sure that you've tested it and you can see how it works. Remember, it's the 38.2 level and the 66.0 level. And I did show you guys the Fibonacci expansion tool and how you can use it as a point to take profit. So make sure you test that out too. So I hope I've covered everything today for those topics. I'm not sure what I'll do tomorrow, but we'll go from there. So everyone's happy so far? That's good. A few people have told me that what I've been showing them in the webinars, they have made some profits from there. So that's good to hear, like the little techniques that I've told them. So as long as you guys are making money and making changes, that's good news. But yeah, guys, so I'll leave it there. I'll catch you guys tomorrow. I'm not sure of the time yet. Maybe I'll do it a bit earlier, but I'll catch you guys tomorrow. Hope you're out.